All right, let's talk about something that is just as important as making profits in the wide world of crypto. It's understanding crypto taxes and all the legal stuff that comes along with it. And I know what you're thinking, taxes, legal stuff, yay. But trust me, it's important. It's like don't leave your house without your keys type of important. You don't want to get caught off guard when it comes to this stuff. Now, I know taxes are not the most thrilling topic, but they're unavoidable, right? Especially in the world of crypto. Things are moving fast. Transactionings are happening at lightning speed. Everyone's trying to make a buck. But if you're not aware of the tax implications, you could be setting yourself up for a big shock when the tax man comes knocking. In fact, all those great profits that you made, you could lose that and more. So that's why it's important to listen to this video so you can get an understanding of what's involved. Let's break it down. So first up, crypto taxes. Cryptocurrency is treated like property in many countries. That's including Australia, the US, and a few others. This means that every time that you buy or sell or trade crypto, you could be triggering a taxable event. Let's say you bought Bitcoin last year for $20,000. This year, it's skyrocketed to $110,000. Now, if you sell it, you've made $90,000. Now, that $90,000 is considered capital gains. And guess what? You're going to have to pay the tax man on that. No, it's not just play money, it's real money, taxable money. And the government realizes that. But it's not all bad news. Let's dig a little bit deeper. Now, here's where it gets interesting. The tax rate depends on a few factors. The most important one being how long have you held onto your crypto? In many countries, if you hold onto your crypto for over a year before selling it, you may be eligible for long-term capital gains tax rates. These are usually lower than short-term rates, which apply if you sell within a year. So long-term holding could save you some cash in the long run. Now, if you're trading crypto regularly, that could shift things around a bit. If you're considered a trader by the tax authorities, your gains may be taxed as ordinary income, which if you're pulling massive gains might mean a higher tax bill. In fact, it's a bit of a balancing act because some people think that crypto gains are automatically tax-free. But unfortunately, the tax authorities don't see it that way. They're looking at actual transactions. All right, here's the part where I really lay it down. Reporting. When it comes to tax time, you need to be able to track every crypto transaction you have made. This means every buy, every sell, every trade, every transfer, every meme coin, every good coin, every bad coin needs to be tracked. This sounds tedious, doesn't it? Well, it can be if you're trading a lot, but there's good news. There's many tools out there that you can use. Tools like tax calculators, accounting software, exchange reports can make things easier. So step one, making sure you're keeping detailed records of your transactions. Step two, you got to get organized. Use apps like CoinTracker or Coinly to automatically track your crypto movements, or you can manually track them, but trust me, that gets messy. You've got a few too many Solana meme coins in your bag and it gets hard to track what went where. Here's the thing, crypto is decentralized. That's great, right? But it also means it's not always easy to pin down who owns what or who is making the transaction. And this is where things like cross-border transactions come into play. If you're trading with someone in another country, there could be additional tax implications depending on where you are, where you live, where your trading partner lives. This adds layers of complexity, so it's essential to stay on top of your local tax regulations and consult a professional if needed. There's many out there. Now let's talk about the legal side of things, because crypto isn't just about numbers, it's about laws too. The regulatory environment around cryptocurrency is ever evolving. It was one of the bigger talking points in the recent US election. Some governments love it, some governments hate it, and some, well, they're still figuring it out. They don't know which side of the fence they're on, which means you need to know the legal implications in your own country. Some of the biggest issues people face are things like classification of crypto, anti-money laundering rules, and all the rules surrounding initial coin offerings, ICOs. Let's start with the basics. What is cryptocurrency? Different countries have different rules, but many categorize crypto as property, a commodity, or even a currency. Each classification comes with different legal obligations. For example, in the US, the IRS treats crypto as property. In Australia, the ATO, Australian Tax Office, treats it pretty much the same. This affects how you report your crypto on your taxes. Then there's anti-money laundering, or AML. Most countries have laws in place that prevent money laundering and cryptocurrencies because they're so easy to transfer globally and could be used for illicit activities. To prevent this, platforms are required to enforce Know Your Customer (KYC) checks. This is where you're required to verify your identity before you can trade crypto on most centralized exchanges. So expect to be asked for a copy of your ID and proof of addresses when signing up. Now ICOs, if you've ever thought about launching your own coin or token, you'll need to be aware of security regulations. If your ICO is seen as offering a security, you may be subject to securities laws, which means you could face additional legal hoops. Not to mention, if you're an investor in ICOs, it's essential that you do your due diligence. ICOs aren't always regulated in the same way as traditional securities. Here's the golden rule: stay informed, stay compliant. The rules around crypto are consistently evolving. New regulations are being proposed, new tax rulings are issued, and new legal precedents are being set. The best thing you can do is stay on top of changes. Use trusted sources and consult professionals. You don't want to get caught in the dark with this. All right, to sum it up. First, track all of your crypto transactions. Second, use tools to make reporting easier. Third, stay on top of your local regulations. And if you need to, ask a tax professional or a lawyer to help guide you through this. Don't forget, the world of crypto may seem decentralized, but the taxman and the law are definitely not. They'll catch up with you sooner or later if you're not careful. Thanks for sticking with me, folks. I know it's a lot to take in, but trust me, understanding crypto taxes and the legal issues will now save you a ton of headaches down the line. Stay smart, stay compliant, and let's keep making moves in the world of crypto without any unwanted surprises. I'll catch you on the next one.